Hi, this is Roger Conrad. I'm co-editor of MLP Profits with Elliott Gue. And what I want to talk about briefly today is the impact of the big news in the energy sector, really the biggest news of the year in the energy sector, and that is the Exxon Mobile takeover of XTO. We don't cover either of these companies in MLP Profits, but we do cover obviously a huge number of energy companies, and particularly energy companies involved with infrastructure, such as pipelines, gathering facilities, processing, storage facilities, and all these areas have the potential to be very heavily impacted by this deal. It looks like Exxon Mobil, by doing this deal, is really taking ownership of natural gas in North America. And they don't move very often. I think many people might remember the last big merger that Exxon Mobil did, which was back in 1999 when they took over Mobil, creating the world's biggest non-national oil company. And since then, they've kind of been on the sidelines, sitting back, and people have wondered, what are they going to do with this huge cash hoard that they're sitting on? And now we know they're doing this deal. It's a pretty huge deal for the gas in gas industry terms. Not so big for Exxon Mobil, which is always a good thing when you're looking at an acquisition, whether the acquirer can really pull it off without taking a tremendous financial hit. Well, they're going to be able to do that, and what it means is more than likely a lot more usage of gas around the country. There's already some areas that are look very much to be in areas of very strong demand. One being electric power, and specifically natural gas-fired power plants. I think we're going to see a lot more of those constructed. One is backup for renewable energy. Also, natural gas emits less than half the carbon dioxide per megawatt of electricity produced. So it's obviously a pretty easy way to meet some of the goals for reduced carbon emissions, which are mandated on the state level now in much of the country. Looks like they're going to be mandated on the federal level beginning sometime next year. So anyway, it's been called a bridge fuel. It's been called a backup fuel for renewable energy. Whatever the case, it means a lot more plants constructed. Now, to construct these plants and to fuel these plants, you need to have pipelines, storage facilities, processing facilities, and so forth. And this is extremely bullish for the kinds of companies that we have in MLP Profits. The most direct plays, or the most conservative plays, are in the conservative holdings, and these are basically companies that operate fee-for-use assets such as pipelines, such as storage facilities. Price of gas doesn't really impact them that much. Use of gas does impact them, and the more gas usage climbs, the more we'll see these facilities produced. I think one of the key measurements of this industry's strength thus far has been the fact that all new projects have substantially been locked down their customers before the first spadeful of earth is turned. So there really isn't any speculative building, and that bodes very well again for an environment where gas usage rises. So the conservative holdings are the place to go if you're the most conservative. The growth holdings, they tend to make their money on fee for use, but also the fees tend to depend to some extent on the price of gas, the price of oil, the price of the refined products that come from those raw energies. And so they tend to do better when there's more demand for gas, when the price of gas is higher. And then, of course, we have the aggressive holdings that are more or less tied into the price of oil and gas. All three of these groups should benefit from this new dynamic. Probably the most direct beneficiaries, though, will be those that are more involved on the infrastructure side. And that's a good reason to pick up some of these conservative holdings. One question we've gotten from readers recently has been the fact that a lot of our holdings have now gone up and exceed the buy targets. We would advise continuing to follow those buy targets. They are set on parameters that relate to the underlying business strength of each of these MLPs, so we're not setting them on technical factors. If you buy below those prices, you are going to, I think, get very, very substantial returns going forward. If you buy above those prices, those returns may not be so much. So we are in the process, we're always in the process actually of updating our targets, of seeing what's feasible in terms of business worth, and it is possible we'll raise some of these targets. For now, though, please continue to adhere to those targets. They are posted in the portfolio section of the website, mlpprofits.com, and continue to choose which group fits best your risk tolerance. Being the conservative if you're just out there for yield, growth, and aggressive if you're looking more for something giving you a play on energy. And that's the way we continue to advise going. Again, it is possible we'll see some of these targets be raised going forward, but for now we would advise sticking with them. There is a phenomenon that happens in the market, more so with utilities, it's more noticeable, but that is the tendency of income-producing stocks to rally very hard in the last month of the year, last couple months of the year. Part of that's window dressing of the companies. Part of that is companies that do have big gains in the market trying to lock in those returns in less volatile stocks. But one thing that does happen is some of these gains tend to melt away in January. So what that means for us, I think, is that there's a good chance we will get better prices to buy in January. And so in the meantime, again, just be patient, stick with the buy targets. So that's all I have to say today. Thanks for tuning in. Look forward to speaking with you next time.